Silver just dropped 10% in a single week. Gold just posted its worst weekly performance since 1983, and right now, in real time, the COMEX is sitting on 79.2 million ounces of registered silver, while paper claims against that metal run at 7.1 times the physical supply. The paper market is screaming crash. The physical data is screaming something else entirely. If you do not understand the gap between those two signals, you're about to make the single most expensive mistake of this entire cycle. I want to be direct with you about something before we go any further. This channel exists to show you what the institutional money is actually doing, not what mainstream financial television is paid to tell you. If that sounds like the channel you have been looking for, hit subscribe right now, because what I am about to walk you through is not available on any financial news network. What you are going to understand by the end of this video is why the crash happened, who caused it, what the 1983 historical precedent means for where we are today, and most critically, what the divergence between the paper price and physical inventory data is actually telling us. Let me start with the number that should be on every silver holder's mind right now. 79.2 million ounces. That is the current registered COMEX silver inventory as of March 20th, 2026. Registered means immediately deliverable against futures contracts. Not eligible, not stored, deliverable. And that number has dropped 14.1% in the last 30 days alone. 13 million ounces withdrawn in a single month. Now think about what sits on top of that. 7.1 times paper leverage, meaning for every single ounce of physical silver that exists in deliverable form at COMEX, there are 7.1 paper claims against it. Let me say that again so it really lands. 79 million ounces of real metal, 560 million ounces of paper claims. That is not a market. That is a house of cards, and right now, someone is kicking the table. Before we get into who is doing the kicking, let me give you the context that most channels are missing entirely. Gold and silver had a historic run in 2025. Gold surged 66% over the course of that year. Silver did even better, a 135% rally. Both metals continued making headlines into early 2026. And then last week happened. Gold dropped nearly 9.4% in 1 week. Silver tracked more than 10% lower. In a matter of days, months of gains evaporated. And if you are watching the financial news, they gave you the one-line explanation. Inflation data came in hot. The Federal Reserve held rates at 3.5 to 3.75%, and therefore gold goes down. That explanation is not wrong. It is just approximately as useful as explaining a car crash by saying the car stopped moving. Here is what is actually happening underneath the surface. Think of it as 6 dominoes falling in sequence. Domino 1, military strikes hit Iran. Iran retaliates, the Strait of Hormuz gets disrupted, and tanker traffic collapses towards zero. Domino 2, 20% of global oil supply gets cut off. Oil rockets above $112 per barrel in Friday's session alone. Goldman Sachs is projecting prices that could reach $180 if disruption persists. We are looking at one of the largest energy supply shocks since the 1970s. Domino 3, when oil is above $100, everything gets more expensive. Your gas, your food, your fertilizer, your pharmaceuticals, they all run on oil. The inflation problem the market thought was fading is now accelerating in real time. Domino 4, the Federal Reserve is trapped. They cannot cut rates into an oil shock because cutting rates into rising inflation is how you get the 1970s all over again. The Fed is holding. Some voices on Wall Street are now discussing rate increases. Even the European Central Bank is signaling tightening because of oil-driven inflation. Domino 5, bond yields rise, the dollar strengthens. When you can get attractive returns on US Treasury bonds denominated in dollars, global capital floods into dollars to access those yields. The dollar index moves higher. Domino 6, the machines take over. Hedge fund algorithms run on preset rules. Higher bond yields and a stronger dollar mean one thing to an algorithm: dump gold. Billions of dollars in paper gold and paper silver get sold automatically with no consideration for wars, no consideration for safe haven demand, no consideration for the physical supply underneath the contracts. The machines do not care, and when they move fast. Now pause here for a second, because if you have been following this channel, you know this is exactly the forced liquidation paradox we have discussed before. The very events that are most bullish for precious metals long term, oil shocks, inflation, geopolitical crisis, can and do trigger short-term paper price crashes because of the leverage sitting in the system. Paper silver gets dumped, not because silver's fundamental case weakened. It gets dumped because other positions needed cash collateral. This is flow-driven selling, not thesis-driven selling. Those are completely different animals, and if you do not understand the difference, you will sell at the exact wrong moment every single time. Drop the word flows in the comments right now. If that distinction just clarified something for you, I read every comment, and that tells me exactly who is paying attention. But there is a second layer to this crash that almost nobody is covering, and it requires a history lesson. Go back to February of 1983. Gold suffered one of its worst weekly declines in decades, a nearly identical pattern to what we are watching right now. And the cause was not a financial crisis, not a bank collapse. It was Middle Eastern oil-producing nations selling their gold reserves to raise cash. Here is the context. By 1983, the world was swimming in oil. The North Sea had come online. Alaska was ramping up production. Brazil, Egypt, India, Malaysia were all pumping. US oil imports dropped significantly. OPEC's market share collapsed. The Gulf states could no longer control the oil price. Revenue dried up. And to fund their governments and defend their currency pegs to the US dollar, because almost every Gulf state pegs its currency to the dollar, they needed to sell assets. Gold was the most liquid asset they had. Now fast forward to March 2026. The mechanism is almost identical, but the trigger is inverted. In 1983, Gulf states had too much oil and not enough buyers. In 2026, Gulf states have oil priced at record highs, but they cannot physically ship it because the Strait of Hormuz is disrupted. The oil is sitting in tanks. Storage is full. Saudi Arabia and Kuwait have already begun cutting production because they have no place to put the output. Revenue has collapsed, not because the price is low, but because they cannot move the product. The Saudi reserves stand at 300 tons of gold. Qatar sits on 115 tons, and if you need dollars to defend a currency peg and fund government operations, and your primary revenue source just got physically blocked, you sell what you can sell, you sell gold. The pattern from 1983 is playing out with almost surgical precision in 2026. If you are still here, hit the like button right now. What we are covering is not available anywhere else in this format, and that button tells the algorithm that real investors value this kind of analysis. Now, I want to talk about something that should genuinely concern every person watching this video. Throughout 2025 and into 2026, retail investors poured over $70 billion into gold ETFs. A significant portion of those inflows went into leverage products, 2x and 3x ETFs that amplify the daily move in gold's price. When gold is going up, those products feel like genius. Gold up 2%, your leveraged ETF up 6%. You feel like you cracked the code. But leveraged ETFs have a structural feature that most investors do not fully appreciate until it is too late. They rebalance daily, and when the price of gold goes down, those products are mechanically forced to sell. Lower prices trigger leveraged margin calls. Margin calls create more selling creates lower prices. It is a death spiral, and the iShares Silver Trust ETF was down 4.4% in pre-market trading on Thursday alone. The ProShares Ultra Silver ETF shed 20%. Mining stocks followed. First Majestic Silver and Core Mining both falling more than 5 and 6% respectively. The very financial products that carried retail investors up to the highs became the wrecking ball that smashed prices back down. This is not a conspiracy. This is financial engineering working exactly as designed for someone, just not for you. Here is the most important insight of this entire video. I need you to really think about what I am about to say. While the paper price was crashing this week, physical metal was leaving COMEX vaults at a pace that is historic by any measure. COMEX registered silver inventory has declined 31% since October of 2025. 13 million ounces drained in the last 30 days alone. The coverage ratio, the percentage of paper claims that could actually be satisfied with physical metal, now stands at 14.1%. Below 15% is considered stress territory. Below 15% is historically rare. And the April 2026 first notice day is just 7 business days away, with 9.8 million ounces still standing for delivery against that 79 million ounce registered base. Meanwhile, Shanghai Gold Exchange inventory has dropped from 559 tons in November 2025 to 318 tons in February 2026, a 43% decline in under 4 months. Asian buyers, central banks, institutional accounts, physical buyers are taking metal at these lower paper prices. The paper market says gold and silver are crashing. The physical market says gold and silver are on sale. Two markets, two completely different stories. Historically, when paper and physical diverge this sharply, physical wins. And here is what I want you to understand about the path forward. This is not the end of the bull case for precious metals. It may in fact be the opposite, but you need to be positioned correctly. If you are holding leveraged products, you are playing a dangerous game in a volatile environment. Physical metal and unleveraged ETFs that actually hold metal are a completely different conversation. You are not subject to the death spiral. You are not getting margin call. You are holding the thing that Asian central banks are currently buying at a discount while retail investors panic sell. Two watch lists matter right now for understanding the reversal. The dollar index. If the DXY is above 100, that is pressure on metals. If it drops toward 96 or 97, the environment shifts materially. And the 10-year Treasury yield above 4%, and you are fighting headwinds. Below 3.5%, and the environment flips. The moment the Federal Reserve is forced to cut rates, whether by recession, a credit event, or economic slowdown, gold and silver reverse. That is not speculation, that is the mechanism. And I will be honest with you about the risk. 1983 did not produce an immediate bounce. Gold entered a consolidation phase that lasted years. That scenario is possible here. Central bank demand, de-dollarization, and industrial silver consumption from solar panels and artificial intelligence infrastructure make the setup fundamentally different from 1983. But you should be prepared for the possibility that this is not a one-week correction. Patient accumulation with a multi-year time horizon is how the biggest gains in precious metals history have been captured. Comment your honest answer below. Do you think silver sees $75 before it sees $100? I want to hear the real takes from this community, not the hype, the analysis. There are 3 types of people watching this video right now. The first type is scared. They are looking at a 10% weekly drop and wondering if everything they believed about silver and gold was wrong. The second type is confused. They understand there is something important happening, but they cannot reconcile why a war and an oil crisis is making their metals cheaper. The third type is positioned. They see the paper price drop as the paper market doing what paper markets do, and they are watching the physical inventory data, the COMEX drain, the Asian premium, and the central bank buying patterns, and they understand that wealth is being transferred right now from people who do not understand the mechanism to people who do. Which type are you? Drop 1, 2, or 3 in the comments, and let us see where this community actually stands. If this analysis gave you a different framework for understanding what is happening in the metals market right now, share it with one person who holds silver or gold. They need this context. Not every reference is available on mainstream media. Every data point we covered today is in the description below. This is not financial advice. Every individual must assess their own risk tolerance. time horizon, and financial circumstances before making any decision. Like the video if the COMEX data alone was worth your time. Subscribe and hit the notification bell because when the reversal signal appears, and it will appear, you want to be the first to know the market is transferring wealth right now. The question is which direction it flows to you.